Joining us here at Post 9 is David Bahnsen, founder and CIO of the Bahnsen Group. Welcome. So are you feeling a little more cautious about the market to start the year?
I've been cautious for a while just from a valuation standpoint. My concern, honestly, is not bond yields. I think that the 10-year going higher can be a very good thing for stocks if it's because of real growth. You know, the 10-year is up 100 basis points and inflation expectations are up 12 basis points. That's a lot of real growth increase. That can be good for stocks. The problem is there's a threshold at which it starts to weigh on those already high valuations.
But it's, good for growth in what way? It means higher mortgage rates. It means higher credit card rates. There's already a report today in the FT about bankruptcies going up in the U.S. because of higher interest rates. So there's the rate problem for the economy, and then there's inflationary pressure.
And those are two totally different things. Growth is not inflationary. So that's my biggest difference over the last several years in the big narrative around inflation is the belief that people having jobs causes inflation. It doesn't. It never has. More supply, more growth is good for inflation. It puts downward pressure as we produce more goods and services. Issue about borrowing rates is an issue, and it's why the Fed has to control that at the short end of the curve. There is nothing they can do at the long end of the curve. But again, if you start getting much north of 5%, I think that does weigh on expectations.
You think that's the threshold that you mentioned earlier, 5?
Yeah, and again, it's not a perfect science, but I believe that we have not seen it go above 5, and everything in the 4s so far has been pretty benign. You have stocks up 20% plus 2 years in a row with a 10-year mostly over 4%.
Right. You mentioned the Fed can't do much about the long end. Can Congress? And do you have confidence they will?
Congress can do some bad things for the long end. There's not a lot of good things, nor is there a lot I'd want them to do. Look, the Fed can do stuff with quantitative tightening and easing, but I don't want that either. They've really curtailed a lot of the tightening. That's really meant to more manipulate the long end. The Fed funds rate is being cut and the long end has gone higher. You're 35 basis points spread right now in the 210. That's very healthy. That's indicating a good economy. But again, with valuations at 22, 23 times, there's vulnerability.
So you think it's more of a positive signal about growth than, say, a negative signal about foreign demand or worries about our fiscal sustainability?
That's right. That's right. If people are worried about fiscal sustainability, you don't get 4.6. You get something much higher than that. This is very marginal increase and still within a range that we were at 2 years ago. We were at 5%. Right. So I just don't think that there's anybody. And again, inflation expectations would tell you if I were wrong, because the tip spreads would be blowing out, and they most certainly are not.
Still, though, it's the worst. Isn't it the worst return on a 10-year in an easing cycle that we've seen, maybe ever?
Yeah, the difference is it was positive, where in 2022 you got double-digit negative. And so when you have a protective coupon, it helps a great deal. The idea that the 10-year was at 3.8, went to the 4s last year, and you still had a positive return in treasuries, that's what the benefit of a long coupon cushion is.
So you're worried about equity valuations right now, you said. But what were valuations when we started the year last year? They were elevated as well.
That's right. It's not a timing. It's not a timing mechanism. Yeah. And so, look, the top 10 stocks a year ago were 28% of the market. Now they're 38% of the market. You're at a 1.1% yield in the S&P, the highest price to book in history, and you're at 22, 23 times. It doesn't mean this stuff collapses in 2 months or even 6 months, but it's vulnerable, and the risk reward is what I'm referring to. That's why we're just not index investors. We prefer to be bottom-up and selective.
We're about to hear from President-elect Trump at Mar-a-Lago, which is amazing that we have this news conference now from the President's Resort and Country Club happening even before he gets inaugurated with all these billion-dollar investments. $20 billion we're expecting, had $100 billion from Masa a few weeks ago. Does that change your view as an investor?
No, I'm not surprised. If you remember back in 2016, even with the same gentleman and same company with SoftBank, we saw a similar announcement, although that time it wasn't Mar-a-Lago. It was down at Trump Tower, right? I think that you're going to see a lot of this. There's a lot of people currying for position with the administration, but data centers are something people should be investing in. Foreign capital, domestic capital, we're heavily invested in the space. That's just a great opportunity. I don't think it speaks to something unique about the administration. That opportunity is there anyways. The difference is President Trump wants to use it as sort of a selling point for America. And I thought your points earlier were fascinating. It really is somewhat contradictory to blocking of this steel deal. Do we want foreign capital or not? I'm one who just finds it mystifying that both President Trump and President Biden have opposed that deal when there are solid U.S. companies with labor conditions that people are agreeing to, national security issues that are addressed, and foreign capital wants to come in. We should want that investment.